Hi everybody, welcome to another update on the stock screener. I got a request from someone on YouTube and he wanted to look at Argonaut Gold. So that's what we are going to do right now and compare it to Soma Gold. So let's see. First of all, Argonaut Gold has a lot of mines and all of their mines are crap, as you can see here. All-in sustaining cost at 2000. So I'm going to just ignore all of those other mines and just skip to Magino, which is their new project, because those other mines are not going to make any money anyway. So Magino, we have a feasibility study at 1600 gold, NPV 5% discount rate. This is how production is going to be done. It's a 19-year mine life, but only 10 years have high production, and then this is going to be lower in production. So here are the cash flows, and as you can see here, 300 million in capex. So that's the 300 million here. That red line, 300. And then they will slowly increase the cash flows, break even in 2027, and then rise to 800 million. And yeah, it's probably stay at 800 million here in 2039. So that's how it should look like at 1600 and NPV 5. But we are going to use NPV 10% because I always use 10%. And we are going to use the current gold price, 2000. I think it will go higher to 2200. So here you can see the AISC, it's below 1000. That's a very good project. Production first 80,000 and then going to 150,000. And it will stay around 130, 140,000 for several years. Capex, I'm not sure how much the capex is, but when we look at the guidance, it should be below 50 million. So not sure if this is including sustaining capex. It's not given here. So a normal company like this should have at least 10 million in growth capex per year. So I put 10 million in here as they will want to grow the resource. Interest needs to be paid. They have a lot of debt, around 200 million. So that's at least 15 million interest per year. They can pay it off probably in a few years, so it goes down to 0. Tax rate, I think it's 36%, not sure, but they have some Ontario taxes at 10%, some other federal taxes at 11% plus 15%, etc. So I took 36%. And then we get the following cash flows. So it goes eventually to 550 million US in 2033. So that's about here, here. So here it is around, yeah, also around 500 million, maybe 600 million. So it matches. So it will probably go up even more, of course, around 200 million higher, and then stay around this level. So is this a good company or not? Well, look at the enterprise value currently. They have a lot of debt, so it's at 530 million enterprise value. That's somewhere here. I think that's a bit overvalued. So you need to wait 10 years to get your money back. Of course, when the gold price goes higher, then the whole curve will shift up. And also those other crappy mines will become profitable. So there is a lot of leverage on this company. But at the current gold price at 2000, this will be the trajectory. And I think it's a bit overvalued. I would buy it maybe at 20% discount. Yeah. Then I would get interested. Soma Gold, you can look at the numbers here. Enterprise value is only 70 million, and you will get to that enterprise value already in 2 years. So this is a much better project. This is going to get to the enterprise value in 10 years. Right? Visualized like this. So I still think that Soma Gold is better than Argonaut Gold. This has, of course, a much higher mine life, but it's also a bit overvalued. So what's the advantage of having Argonaut Gold? Well, you don't need to worry about resources. So they can just keep on producing and cash flow will keep on coming in, right? If the gold price goes down, then cash flow will be a bit lower. If the gold price goes up, cash flow will be higher. At Soma Gold, we will have a lot of cash flow, but of course here the resources are a bit less, only 3 to 5 mine life currently. So that's the worry about Soma Gold. We need to drill more resources. And that's exactly what they are doing right now. So 2 different companies. I still prefer Soma Gold. And I'll see you in the next video.